So in this video, we're going to talk about the sales tax money trail. Now, everybody said, hey, sales tax, it's a pass-through expense for a company. The company doesn't actually, take your cash that you give them and pocket it, right? They have to give it to the government. Now, we're going to walk through exactly what that means. So as you can see in the visual, right, there's really two steps to the sales tax money trail. And what you'll notice is that on the left, right, we have our consumers or individuals. And there's that green arrow that goes right over to the government, right? And in the middle, we have the company. So what exactly does that mean? Well, in step one, that's when we as the consumers pay sales tax to the company. Now, the company will receive that cash from us, right? So when we buy something for 10 bucks, there's a 7% sales tax, right? That 70 cents, that gets added onto our total payment to the company. Now, for the company, they take the cash, put it on their balance sheet, but they do not record any revenue. So every state or jurisdiction has different requirements, but probably at least on a monthly or quarterly basis, the company is going to send the cash to the tax authorities, right? Which is always going to be the government. So I'll give you an example of exactly how this impacts the balance sheet and the income statement, right? So in this journal entry example, we're going to talk about St. Croix Brewery, right? Why? Well, I went to St. Croix a few years ago. It's an amazing island down in the Virgin Islands. It's one of my favorite places. Unfortunately, it was hit by the hurricanes a few years ago, but from what I understand, it has come back to life. So definitely go down there and pump some of the money into this economy. Now, since St. Croix is a tourist destination, they charge a lot of sales tax. And beer's expensive, right? As you can see, that beer, it was $50, and on that was $15 of sales tax. So when we actually buy the beer, right, the company, they would debit cash for that $65 because, as I said before, they're getting that full amount. And then they're going to record a credit to sales revenue for the $50 of just the beer, right? And then they have to record a liability, and we're going to call that sales tax payable, and that's for the $15 of sales tax. And that will sit as a liability or payable on the balance sheet until they remit it to the government. So the day that they remit it to the government, well, we're going to remove that liability by debiting sales tax payable for 15 bucks. And then since we're paying it to the government, it's a cash outflow for $15, right? So overall, from a sales tax perspective, over the course of a year, the impact of the balance sheet should be neutral, assuming that we've received the cash and then we've paid it out. And one more thing to touch on, right? We haven't talked about the income statement, and that's because as a seller, right, as a company that's selling a product to consumers, there is no income statement impact from sales tax. Again, it's just simply a pass-through expense, meaning it doesn't actually hit our income statement. Now, if you're looking at a company's income statement and you see sales tax expense, well, that's because they probably bought goods or services from another company that charged them sales tax, right? That is an expense. So again, if you're selling goods or services, it's just a pass-through expense. But if you're a buyer, you will have to pay sales tax expense, and that should be recorded on your income statement as an expense. Are we ready for some good news? Well, the good news is you now know more about sales tax and the impact to the financial statements than most people out there, right? So just keep that in mind and revisit this video if you ever get tripped up.